Meet John, a passionate Forex trader who, like many, believed that predicting market movements was the key to consistent profits. In the intricate world of Forex trading, John was a steadfast believer in the power of prediction. He spent countless hours poring over charts, analyzing news, and trying to spot patterns, all in a quest to predict the next big market move. However, despite his best efforts, success often eluded him. This pursuit of prediction was not only exhausting, but also incredibly frustrating for John. His trading account fluctuated wildly. His stress levels were through the roof, and he was no closer to the consistent profits he desired. The more he tried to predict, the more unpredictable the market seemed. Little did John know, he was caught in a common misconception that was holding him back from achieving his trading goals. But then, an unexpected question was posed to him. John, have you ever considered that the Forex market is inherently random to some extent? One day, John attended a trading seminar where he met Sarah, a seasoned trader with a different perspective. Sarah, with a twinkle in her eye, asked John a question that would change his trading life forever. John, have you ever considered that the Forex market is inherently random to some extent? John, puzzled, responded with a hesitant, "Random, but how can that be?" Sarah, eager to share her wisdom, explained, "Well, John, while we can't predict every market move, we can understand probabilities and risk management to make consistent profits." This was a novel concept for John, who had been so fixated on prediction. Sarah taught him to shift his focus towards managing risk, rather than trying to predict every twist and turn of the market. John had a eureka moment. It's not about predicting, it's about managing risk. This was the turning point in John's journey, the moment he began to break free from the common misconception and embrace the randomness of Forex. John started setting strict stop-loss and take-profit orders, diversifying his trades, and sizing his positions appropriately. He was no longer trying to predict the unpredictable, but rather, he was learning to manage the inherent randomness of the Forex market. This was a significant shift in his trading strategy, and it marked the beginning of a new chapter in his trading journey. Instead of obsessing over every market move, John focused on managing his risk. He began to set clear stop-loss orders to limit his potential losses. This meant deciding in advance how much he was willing to lose on a trade if the market didn't move in his favor. It was a way of protecting his trading capital from significant losses. Next, John started setting take-profit orders. These were predetermined levels at which he would close a trade to lock in profits. It was a way of ensuring he didn't get greedy and hold on to a winning trade for too long, only for the market to reverse and wipe out his gains. John also diversified his trades. Instead of putting all his eggs in one basket, he spread his risk across different currency pairs. This reduced the likelihood of a single bad trade wiping out his account. It was a way of embracing the randomness of the Forex market, acknowledging that not all trades would be winners. Finally, John paid careful attention to position sizing. He made sure not to risk more than a small percentage of his trading capital on any single trade. This meant he could withstand a string of losses without jeopardizing his account. As John implemented these risk management strategies, he began to see consistent growth in his account. He no longer spent sleepless nights trying to predict the next big market move. Instead, he focused on managing his risk and adapting to the ever-changing market conditions. This shift in strategy was transformative for John. He had finally broken free from the cycle of prediction and was now navigating the Forex market with a newfound sense of confidence and control. "My account is growing consistently now. I no longer stress about predicting the unpredictable," John exclaimed with a sense of relief and accomplishment. This marked a significant milestone in John's journey to trading success. John broke free from the mindset that had held him back for so long. He had learned to embrace the randomness of the Forex market. It was a transformation that saw him evolve from a frustrated trader, chasing the elusive goal of prediction, to a confident trader who understood the essence of managing risk. Sarah's words echoed in his mind. It's not about predicting the future, it's about adapting to the present and managing your risk effectively. This became John's mantra, his guiding principle in navigating the unpredictable waters of Forex trading. He no longer viewed the market as a puzzle to be solved, but rather as a game of probabilities. The unpredictability, once a cause for stress, became a source of opportunity. He found joy in the randomness, relishing the freedom it gave him to focus on what he could control, his risk management strategy. Today, John is a successful Forex trader, living proof that you don't need to predict the market's every move to make money consistently. So, if you find yourself trapped in the cycle of prediction, here are some practical ways to break free. First, embrace probability. Understand that Forex trading is a game of probabilities, not certainties. Each trade you place is essentially a bet on a particular outcome happening over another. And while you can't predict these outcomes with 100% certainty, you can make educated guesses based on market analysis and historical data. Second, set clear strategies. Develop a trading plan with well-defined entry and exit points. This plan should also include your risk tolerance and how much of your portfolio you're willing to risk on each trade. Once you have this plan, stick to it. Emotion-driven decisions can lead to poor trading outcomes. Third, learn from your mistakes. Every trader, no matter how experienced, will face losses. But instead of viewing them as failures, see them as valuable lessons. Analyze what went wrong and adjust your strategy accordingly. By doing so, you'll continually improve your trading skills and increase your chances of success in the long run. Fourth, diversify your trades. Don't put all your eggs in one basket. By spreading your trades across different currency pairs and time frames, you can mitigate risk and increase your chances of making a profit. Fifth, focus on risk management. This includes setting strict stop loss and take profit orders, sizing your positions appropriately, and never risking more than you can afford to lose. Remember, the goal is not to win every single trade, but to come out ahead over a series of trades. And lastly, keep learning. The Forex market is constantly changing and evolving. Stay up to date with market news, continually educate yourself, and always be open to new strategies and ideas. Remember, in Forex trading, it's not about predicting the future, it's about adapting to the present and managing your risk effectively.